On January 26th, China's central bank set the daily yuan fixing at 6.9843 per dollar. Reuters said that fixing sat about 551 pips stronger than a common market model. That is not a normal day-to-day wiggle. It is a policy hand on the steering wheel. Why let the yuan run, but keep it on a tight leash? By the end, you will know what that fixing gap means. You will also know 3 specific signals to track. Those signals tell you when the rally is being allowed. They also tell you when the breaks are coming. Keep one real-world picture in your head. A Shenzhen exporter sells kitchen appliances to the U.S. Call the company Yuan Home. They invoice in dollars. They pay workers and suppliers in yuan. This week, they are staring at Lunar New Year payroll deadlines. Every morning, the fixing sets their conversion baseline. Every afternoon, offshore trading sets their hedge cost. Here is what happened. Late last week into Monday, the yuan pushed to a multi-month high. The receipt is the daily fix itself. It prints at a set time, with a number you can screenshot. On January 30th, CFETS showed a central parity around 6.9678. That is another hard print, not a rumor. Now add a second receipt. The U.S. Treasury's January 2026 foreign exchange report described the same control lever. It said the central parity has been used to manage the pace of appreciation. That frames intent. It tells you this is not just a market shrug, it is a managed glide path. For Yuan Home, the first effect is immediate. They sell the same dollars and get more yuan back. That helps margins on paper. But it also changes timing. If managers expect more strengthening, they delay conversion. That delay can create a sudden burst of demand later. That is why the fixing becomes the clock. Why did it happen? Start with the flow story. Ahead of Lunar New Year, corporates often need yuan liquidity. Exporters convert dollar receipts. Importers settle supplier bills. Banks see seasonal demand for the home currency. Now, layer the policy motive. A stronger currency lowers the local price of imports. It can cool imported inflation pressure. But a fast one-way move invites speculation. It also squeezes exporters. So authorities often care less about direction than speed. That is where the midpoint gap comes in. If the model says the fix should be weaker, but the fix prints stronger, the gap is the break. It signals the central bank wants a stronger yuan than pure pricing would imply. If the gap widens sharply, it signals resistance to a free run. It is a daily policy meter for FX. For Yuan Home, the second consequence is less obvious. Their bank hedges by referencing offshore pricing and forward points. If CNH liquidity tightens, hedging can get expensive. Even if spot looks friendly, the hedge can feel like stress. Now, look at why it matters. A guided yuan rally changes regional FX behavior. Markets responded in a very specific pattern. FX did the work first, because the fixing is the receipt. Rates were mostly about expectations, not a shock. A firmer yuan can reduce imported inflation at the margin. That can ease pressure on local bond yields over time. But if the move is seen as policy-driven, traders also watch liquidity. Offshore CNH funding can tighten when positioning crowds in. That is when the CNH-CNY gap tends to open. You also have a stabilizer in the background. SAFE publishes the reserve stock, and the market watches it as a buffer. If reserves look stable, traders assume the defense capacity is there. If reserves were to fall quickly, confidence can change. No one needs to guess. Those releases are another hard receipt. Asia suppliers and competitors start recalibrating prices. It also changes the dollar story. If the dollar stays soft, the yuan can strengthen with less friction. If the dollar rebounds, management pressure rises fast. The next 24 to 72 hours pressure point is the fix itself. If the PBOC keeps printing a stronger midpoint than models imply, the rally can extend. If they stop doing that, the market reads it as a warning. You often see it first in offshore CNH. That is where positioning expresses itself fastest. For Yuan Home, the third consequence is commercial. They have to price the next shipment to a U.S. retailer. A stronger yuan makes their dollar offer less competitive. They cut margin, or they ask for a higher price. If they misjudge the pace, they lose the order. Now, zoom out to the next 2 to 6 weeks. Seasonal flows fade after the holiday. Then the story becomes growth and credibility. If exports weaken, the incentive shifts towards stability. If activity holds, authorities can tolerate more strength. If this persists into spring, the stakes change again. A sustained yuan appreciation can export disinflation. It can also tighten offshore funding conditions. That is where global dollar liquidity shows up. If CNH funding tightens, cross-border hedging costs rise. Now, the clean part. Exactly 3 signals tell you whether this is controlled strength or a setup for pushback. Signal 1 is the daily midpoint gap. Look at the PBOC fixing versus major bank model estimates. Direction that matters is a widening stronger than model gap. That means the authorities are leaning into strength. Lag is same day because the fix is the event. Signal 2 is the CNH versus CNY spread. Look at USD, CNH, and USD, CNY side by side. Direction that matters is CNH weakening relative to onshore, so the spread widens. That can signal offshore stress or one-way speculation. Lag is intraday to 1 day. Signal 3 is the dollar index trend. Look at DXY or a broad dollar basket. Direction that matters is a renewed dollar rebound. If DXY turns up, keeping the yuan firm usually needs heavier management. Lag is 1 to 3 days. One more receipt before we close this chunk. Reuters framed the move as the yuan hitting a 32-month high with the midpoint carefully lifted. That line captures both sides of the story, strength and control. For Lian Home, that becomes the lesson. A stronger yuan changes conversion timing, hedge costs, and pricing power. And the fix tells you whether the rulebook is stable this week. Now get precise on the 551 pips receipt. A pip here is 1/10,000th in USD CNY terms. So 551 pips is about 0.0551 yuan per dollar. That is 5.5 fen on the fix. It sounds small until you scale it. Take Lian Home again. They have $10 million of receipts to convert. A 0.055 move is about 551,000 yuan difference. That is real payroll money before a holiday. It is also real pricing pressure on the next shipment. This is why the fix matters more than a chart. The fixing is a daily policy decision. It is also a coordination signal. Banks reference it. Corporates anchor to it. Offshore traders try to front-run it. So, what is a model forecast anyway? Most desks estimate what the fixing would be based on the prior close, a basket, and the broader dollar move. When the published fix prints far away, the gap is the message. It says, we prefer a different pace. That can mean stronger today. It can also mean slower tomorrow. There are 2 ways this story can be misunderstood. The first mistake is to treat it like a free market breakout. The second mistake is to treat it like a hard peg. It is neither. It is managed trading with a daily anchor. This is where the onshore and offshore split matters. Onshore is CNY, traded mainly inside China's system. Offshore is CNH, traded in places like Hong Kong. They are connected but not identical. In calm periods, they track closely. In stress, CNH usually moves first. That is why your second signal matters so much. CNH versus CNY is the pressure gauge. If offshore starts weakening against onshore, it often means one of 2 things. Positioning is crowded and funding is tight. Or the market is testing where the authorities push back. Now, tie that to the fixing gap. A stronger than model fix invites bullish positioning. If too many traders chase, CNH funding can tighten. Then the CNH-CNY spread can widen. That is the market saying, this is getting one way. For Lian Home, this becomes consequence number 4. Their bank asks for more margin on hedges, not because the firm is riskier, because volatility and basis risk rise. The hedging cost rises exactly when they need certainty. Now, bring in the U.S. Treasury report as a second anchor. The report describes how the fix has been used to manage the pace of appreciation. That is not daily commentary. It is a formal document dated January 2026. It is the closest thing you get to an official intent receipt from the outside. So, why would officials allow strength right now? There are 3 plausible, non-exclusive motives. First, it signals stability to markets and trading partners. Second, it helps on imported inflation at the margin. Third, it discourages capital from betting on depreciation. But every benefit has a cost. A stronger yuan pressures exporters. It can also tighten domestic financial conditions if it moves too fast. That is why speed control matters. Now, connect it to cross-asset spillovers. When the yuan firms, it can pull the whole Asia FX complex with it. That changes the competitive math for exporters in Korea, Taiwan, and Southeast Asia. It also changes the dollar liquidity narrative, because a coordinated Asian FX move can alter hedging demand for dollars. This is where your third signal, DXY, becomes the external constraint. If the dollar is weakening, authorities can allow a stronger yuan with less visible effort. If the dollar rebounds, the same strategy becomes harder. The market sees it immediately. The fix would need to lean harder, or the rally slows. For Lian Home, this becomes consequence number 5. A U.S. retailer calls and says, "Your competitor in Vietnam just got cheaper." It is not personal, it is FX math. Now, Lian Home must decide whether to absorb FX and keep the contract, or raise the price and risk losing volume. Notice the timing. This is why the holiday matters. Before Lunar New Year, companies care about cash conversion. After the holiday, the focus shifts to new orders and hedging. So the story's clock is not only policy, it is the corporate calendar. Now, run the anomaly scanner explicitly. Here's the mismatch that makes this viral. The currency is strengthening, but the system is still managed daily. That confuses people because they think managed means static. The reality is more interesting. Managed systems can trend and still resist speed. You can often spot the resistance before it hits spot price. It shows up as the fix printing stronger than the models. Then it shows up as CNH behaving differently than CNY. If both happen together, the story is hot. Now, what could break next? The first pressure point is offshore funding. If too much positioning builds, CNH funding conditions tighten. That shows up as a wider CNH-CNY gap. It also shows up in forward pricing. You do not need to predict it. You just watch the spread. The second pressure point is exporters. If the yuan rises faster than margins can absorb, exporters complain. They either cut prices, cut costs, or cut output. That is the real economy spillover. And it is why this is not a niche FX story. The third pressure point is credibility. If the market thinks the fix is being used to force a one-way move, speculative behavior rises. That increases the chance of a sudden pushback day, where the fix prints differently and offshore moves first. For Lian Home, consequence number 6 is strategic. They start asking whether they should invoice some contracts differently or shift more assembly to a cheaper currency zone. Those are slow decisions, but the trigger is fast. It is the FX path over a few weeks. Now zoom into catalysts. In the next 24 to 72 hours, the daily fix is the event. It is the cleanest receipt you will get. In the next 7 days, the holiday flow fade is the event. If the yuan stays firm after the seasonal bid fades, that is a different story. It means something structural is supporting it. Recenter the 3 signals again, because the point is testable. Midpoint gap tells you the policy lean. CNH versus CNY tells you where stress is building. DXY tells you whether the external backdrop helps or hurts. We are not forecasting a direction here. We are tracking a control system in real time, and we are watching for the moment it shifts from allowed to resisted. Let's put the fixing gap into a simple map. There are 3 layers. The fix is the anchor. Onshore spot is the managed market. Offshore CNH is the pressure release. When the fix prints stronger than models expect, it sets a bullish tone. Onshore spot tends to follow, but with guardrails. Offshore can overshoot because it is more positioning driven. If offshore overshoots, that is where the stress shows up first. That is why this story is perfect for risk and recap. It is a real-time control system with receipts. You can literally screenshot the fix each morning. You can screenshot CFET's parity tables. You can also point to the U.S. Treasury report, dated January 2026, describing the same lever. Those are not vibes. Those are receipts. Now, for the viewer, the question is not up or down. The question is allowed or resisted. And the only way to answer that is to watch the control knob daily. Bring Lian Home back, because this is where the mechanism hits the real economy. They are now past payroll. The holiday is close. So, management shifts focus to the next container booking. They need to ship before schedules tighten. They also want to lock an FX rate for March delivery. Here is consequence number 7 for them. If the fix stays strong, their bank offers a worse forward rate for locking dollars. Not because the bank is greedy, because hedging costs move with basis and volatility, so the company faces a choice: lock the hedge and accept the cost, or stay unhedged and accept uncertainty. Neither is right. It is a risk management problem created by the pace of the move. Now, zoom out. This is where the global dollar liquidity lane matters. A stronger RMB can change demand for dollars in two directions. Exporters convert fewer dollars if they expect more RMB strength. But importers may need more dollars if commodity bills rise. At the same time, offshore CNH funding can tighten when positioning crowds in. That can raise the cost of holding CNH shorts. It can also squeeze people who borrowed CNH to fund carry. You can see the spillover into the broader FX complex. When RMB strengthens steadily, it often pulls other Asian currencies in sympathy. That can alter trade competitiveness quickly. It also shifts the narrative for regional central banks, because no one wants to import inflation through a weak currency when a peer is strengthening. Now let's tighten the what breaks first angle. If this story worsens, it shows up in one of three places. First, the offshore spread widens. CNH diverges from CNY. That is stress. It is also a warning that the market is pushing the boundary. Second, the fixing tone changes. The gap shrinks or flips. A smaller, stronger than model gap means less leaning into strength. A weaker than model fix can be a clear break. The market reads it instantly. Third, the real economy starts whispering. Exporters change pricing behavior. They discount, or they slow orders, or they delay hiring. That does not hit the market in a day, but it builds over weeks. Now apply the stakes ladder cleanly to this RMB story. Over the next 24 to 72 hours, the risk is a positioning squeeze. If the fix keeps leaning strong, offshore can run. If offshore runs too far, funding tightens. Then you get a sharp intraday snapback. That is when people feel surprise volatility. Over the next 2 to 6 weeks, the risk is policy messaging friction. If the move stays fast, exporters and local officials push back. Authorities can still prefer a firmer currency, but they will slow the pace. The fix is where you see that shift first. If this persists into the next quarter, the risk becomes structural. A sustained stronger RMB changes trade pricing, profit margins, and import costs. It can also shape commodity demand and inflation transmission. That is when it stops being an FX geek story. It becomes a macro story. Bring Lian home back one more time with a new consequence. Consequence number 8 is negotiation power. If the yuan keeps strengthening, U.S. buyers may demand lower dollar prices. They will say, your currency is doing the work. Lian Home then tries to push back by shortening payment terms. That becomes a working capital story, not just a margin story. Shorter terms mean less financing strain, but buyers resist, so the firm might accept a thinner margin to keep volume. Now you have the cross-asset linkage without pretending RMB alone moves everything. FX changes cash flow changes credit. Credit changes investment and hiring. That is the chain. Now let's make the viewer's checklist extremely concrete. No forecasting, just tracking. Signal 1, the midpoint gap. Where to look. Daily PBOC fixing coverage and FET's parity tables for the printed central parity. What direction matters? A consistently stronger than model fix suggests allowed strength. A sudden shrink in that gap suggests speed control, typical lag, same day. Signal 2, CNH versus CNY, where to look. Any platform that shows USD CNH and USD CNY together. What direction matters? A widening CNH CNY spread signals stress or crowding. A narrowing spread signals calm. Typical lag. Intraday to 1 day, signal 3, DXY. Where to look? A broad dollar index or a basket proxy. What direction matters? A rising dollar makes sustained RMB strength harder to maintain without heavier management. Typical lag, 1 to 3 days. Now, one more receipt moment to keep this dense. On January 30th, CFETs published the central parity at 6.9678. That is the number you show. Then you show the Reuters line about the midpoint being set hundreds of pips away from model forecasts. Those two screenshots explain the entire story visually in 10 seconds. Risk framing, no doom, and no certainty. This can stay calm if it stays orderly. It becomes risky if it turns one way and crowded. The signals above tell you which regime you are in. Now wrap this into a clean, testable conclusion. The Yuan rally itself is not the headline. The daily fixing gap is the headline, because that gap is the best public proxy for policy intent. If you only remember one idea, remember this. Spot price tells you where the market traded. The fixing tells you where policy wants the market to trade. The distance between them is the story. For Lee and Home, the daily consequences keep stacking. Their conversions change, their hedge cost changes, their contract pricing changes, their payment terms negotiations change. And all of that is driven by one number printed each morning. Now, look back at the whole mechanism chain in plain steps. Step 1. Seasonal and macro flows support yuan strength into the holiday. Step 2. Authorities allow some strength, but manage the pace through the fix. Step 3. Traders chase, offshore CNH can run, and funding stress can show up there first. Step 4. If it stays orderly, it becomes a soft disinflation and trade competitiveness story. If it gets crowded, you get snapbacks and policy pushback days. That is why it matters beyond FX. A managed currency trend changes cash flow for exporters and importers. That changes credit demand, that changes investment plans, and over weeks, it changes real economy behavior. Now, your catalyst windows. In the next 24 to 72 hours, the fix is the catalyst. Watch whether the stronger than model gap stays wide. In the next 7 days, watch the post-holiday flow fade. If the yuan stays firm after those flows fade, the story is stronger. It means something more structural is at work. Now, repeat the exact 3 signals one last time, because that is the channel promise. Signal 1. The midpoint gap. Where to look is daily fixing coverage and CFET's parity prints. What direction matters is a persistent stronger than model gap. Lag is same day. Signal 2. CNH versus CNY. Where to look is USD CNH against USD CNY. What direction matters is a widening spread, which signals offshore stress. Lag is intraday to 1 day. Signal 3. The dollar index. Where to look is DXY or a broad dollar basket. What direction matters is a rising dollar, which makes the management task harder. Lag is 1 to 3 days. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.